Have you ever wondered how the pros can glance at two real estate deals that look almost identical and just know which one is the better bet? Well, it's not a superpower. They're using a couple of key metrics that tell the whole story. And today, we're going to break it all down for you.
Okay, so let's jump right in with a classic puzzle. This is something every single investor runs into. Doesn't matter if you're buying a skyscraper or just your first rental property.
Seems like a trick question, but it's not. You put your money in, you get double that money back. So, which one do you pick? The real answer is, you can't decide yet. You're missing a key piece of information. And understanding what that missing piece is, well, that's how you start thinking like a pro. Look at this. Deal A and Deal B, they're basically twins on paper. You invest $1 million, you walk away with $2 million. That's a clean $1 million profit. Based on this alone, it's a total coin flip. To figure this out, we need to call in a couple of detectives. So our first detective is the internal rate of return, or IRR. Now, I like to call IRR the time detective because it is completely 100% obsessed with one thing: when you get your cash. The easiest way to think about IRR is as the investment's yearly growth rate. It's built on a super important idea: the time value of money. Basically, a dollar you have right now is worth way more than a dollar you have to wait 5 years for. Because of that, IRR gives a huge bonus to deals that get your money back to you fast. And that's really where IRR shines. It doesn't just look at the total profit. It looks at the rhythm of the cash flow. Getting a chunk of cash in year 1 makes your IRR look fantastic. Getting that same chunk of cash in year 5, yeah, not so much.
And this isn't just some academic concept, you know? The entire industry runs on this. A super safe, stable, core property, you might be looking for an 8 to 12% IRR. But a really risky, ground-up development? Oh, investors are going to demand 20% or even higher to make that risk worthwhile.
All right, let's bring in our second detective. If IRR is the time detective, then equity multiples, or EM, is the magnitude detective. It asks a much, much simpler question, but it's just as crucial. You can't get much more straightforward than the equity multiple. It could not care less about time. It has one job: to tell you, for every single dollar you invested, how many dollars did you get back in total. That's it. It's simple, it's powerful, and it's really hard to manipulate. And you know what? That simplicity is its greatest strength. It's the perfect partner for IRR. While IRR is geeking out about when you got paid, equity multiples just gives you the cold, hard truth about how much you made. It's the bottom line, cash-in-hand number.
And just to put that in perspective, a pretty standard goal for, say, a 5-year project is what they call a 2x, a 2.0x equity multiple. It just means you doubled your money. You put in $1 million, you got $2 million back. Simple as that.
Okay, the team is assembled. We've got IIR, our time detective, and equity multiple, our magnitude detective. Now, let's go back to our original mystery and finally crack this case. So here they are again. But this time, we have the crucial missing clue: the hold period. Now look, both deals have the exact same 2.0x equity multiple. They both double your money. But Deal A gets it done in just 3 years, while Deal B takes a whole decade. And for Deal A, doubling your money in only 3 years, that gets you an amazing 26% IRR. That's a really strong, really efficient use of your capital. But check out Deal B. Waiting 10 long years for that same 2x profit, your IRR just falls off a cliff, all the way down to 7.2%. It's just not a very good return for tying up your money for that long. And there it is. That's the whole ballgame right there. You absolutely have to have both metrics. The equity multiple told you how much you made, that nice 2x return. But the IRR told you how fast you made it. Looking at one without the other is like trying to read only half a map. But hang on. Let's add one more twist. In this scenario, both deals have the same 15% IRR and the same 2.0 equity multiple. So they're equal, right? Not exactly. Look closer. With Deal C, you're getting cash back every single year. That's a lot less risky than Deal D, where 100% of your money is tied up until the very end. Getting your capital back sooner is always safer. Okay, so you've pretty much mastered the dynamic duo of IRR and equity multiple. Now, let's just quickly add a couple more pro-level concepts to your toolkit so you can really see the whole picture. First up, you always want to ask if the returns you're seeing are levered or unlevered. So unlevered is the property's pure raw performance, as if you paid all cash. But leveraged is what you actually get after you pay the bank.
Using debt or leverage can seriously boost your returns, but it also boosts your risk. The levered return is the one that really matters to your bank account.
And if you're investing in a deal with a sponsor, you have to understand the waterfall. Don't let the name scare you. It's just the rulebook for how profits get split up. Think of it like a series of buckets that have to be filled in order. The first profits fill the investor's bucket. That's the preferred return. Once that's full, the next bucket, which is usually for the sponsor, starts to fill. This structure has a huge impact on your final take-home pay.
All right, finally, let's arm you with a quick checklist. When you're looking at a deal's projections, what are some of the things that should make you just pause and ask a few more tough questions?
Honestly, the best tool you have is just a healthy dose of skepticism. If someone is showing you a 30% IRR, you gotta ask, are these assumptions even remotely realistic? Are they banking on selling the property for a way higher price than they bought it for no good reason? Are they assuming rents are going to the moon? Always, always question what's behind those big, shiny numbers.
And that brings us right back to where we started. These two metrics are a team. They're partners. You need both of them to tell the full story. IRR is all about the speed and efficiency, while equity multiple is all about the sheer size and magnitude of your profit. So I'm going to leave you with this. The next time you look at any investment, ask yourself this one simple question. Is this amazing return coming from a smart plan and skillful work, or is it just built on a house of cards of risky, optimistic guesses about the future? Answering that question, that's the real secret to investing. Thanks for watching.